Hey guys, Chris from Debtors here, and in this video, I'm going to show you the solution for question 2 from the May 2014 PoA Paper 2. If you want to see the solutions for the other questions on this paper, I'm going to put a card up there and a link in the description below, so be sure to check those out as well. And with that said, let's get into the question. Okay, so as per usual, we'll take a read of the information. JT Enterprises, whose purchases and sales are all on credit, prepares control accounts at the end of every month. Okay, so what else does it tell us here? At the end of April 2014, JT Enterprises provided the following information on its accounts payable and its accounts receivable. Okay, so long story short, we have two control accounts to do, an accounts payable control account and an accounts receivable control account. So instead of going through all of this information and explaining what goes where and then going back to the control accounts, I'm going to do the accounts payable control account first and then the accounts receivable control account. And by the way, if you have not yet checked out my control accounts video, I'm going to put a card for it up there in the corner, as well as a link to it in the description below. Now, it's one of my earlier videos, so it's not as good quality, but it's still pretty useful. Most people have said they found it very useful. So I hope you find it useful too. Okay, on to the question. Okay, so for accounts payable, we're seeing the first thing they give us are the opening balances, 5,100 on the credit side, 310 on the debit side. So let's start putting those things in. So we're going to put in the credit balance first of 5,100 and then the debit balance of 310. So accounts payable, or as I have it here, purchases ledger control account. Remember, it's summarizing the entire purchases ledger, which means all of the accounts for our trade creditors. So in essence, this is a liability account and should have an opening credit balance. Why would there be an opening debit balance? Long story short, sometimes we make overpayments to our creditors or they have refunds for us for multiple reasons. In that case, they would owe us money, which essentially would be like a debtor. But of course, we don't want to have to go and transfer an account that is typically for a creditor to the debtor's control account, to the sales ledger. We leave it here and we just show that, hey, they owe us some money. Cool. All right, next, what else do we have across here? So we have purchases for the month of April. Now, the question did tell us at top that all purchases and sales are made on credit. So that's going to go on the credit side of the control account because when you make credit purchases, you take goods without paying for them, but you promise to pay for them later, which means you have now incurred a liability and it's increasing. So to record an increase in a liability, we have to credit the liability account. Good. Next, we have purchases returns. So if you return some of those goods, you no longer have to pay for them, which means you have reduced your liability. So if we credit to increase a liability, to reduce it or to decrease it, we have to do the opposite, which is debit the liability account. So you're going to see purchases returns on that side. In the same vein, the payments to suppliers represent amounts we have paid to suppliers, as in paying off the amount we owe them, reducing the debt, reducing the liability, which of course, as I just said, requires a debit to the liability account. Next, we have discounts received. So discounts received, that's where our creditors allow us to pay less, as in they actually decrease our liability for us to encourage us to pay a bit faster. And as we just said, decreases to liabilities go on the debit side of the liability account. Next, we have prepayment by check to suppliers. So when you pay or prepay, that's going to go on the debit side of the liability account. So it's going to go here, right? So it says prepayment by check to suppliers. Now, that may mean that we have placed an order and we're paying in advance, right? Okay, now it says here late payment charge. So if we didn't pay on time, they might charge us some interest or something, and that's going to increase the amount we have to repay. So that's going to increase the liability and will therefore go on the credit side here. Okay, next item we have is the closing balance 270. Now that's the closing debit balance, and they haven't given us a closing credit balance. Now what that means is we have to therefore find the closing credit balance, but there actually is one extra thing which I have to scroll down to show you. So it says here, note, a firm, Escrow Limited, is a supplier and a customer of JT Enterprises. At 30th April, Escrow Limited balances in the ledgers of JT Enterprises were as follows. Purchases ledger, so we owe them $10.50. Sales ledger, they owe us $3.75. And it says here, the firm sets off the appropriate amount through the control accounts. Okay, so I want you to listen to me very carefully. Let's say you owe somebody $10. So that's your liability. Let's say that same person owes you $8. So that's a debtor. So instead of them paying you $8 and you paying them $10, you'll just pay them $2. the extra amount above the 8. So in essence, what you are doing is you are cancelling the 8. You are setting off the 8. So if we scale it up now, if we owe somebody 1,050 and they owe us 375, we'll just pay them the difference between 1,050 and 375. But what it means, listen to me now, what it means is that you are setting off or cancelling the 375. Whenever you have set off and they give you two figures and you have to figure out which one it is, and you have a purchases ledger figure and a sales ledger figure, you always use the lower one. Set off is a cancellation of common debt, and we always use the lower figure. Now, we are cancelling common debt, so it means we are going to be reducing the liability by 375, which means we're going to have an entry on the debit side that shows that reduction in the liability. Okay, now we could get on with balancing of the account, but first we have to put in the debit balance. Now, the debit balance will be brought down on the debit side as seen here. But before you can be brought down on the debit side, you have to be carried down from the credit side. Now what's going to happen is we are going to have to total up both sides, and you're going to see 69,135, 69,135, right? That's what we get when we add up this side. In order for this side to be equal to 69,135, we have to put a balance carried down from here. So how do we find that balance? Simple. You add up this side, you get 69,135. You add up this side, whatever it gets, and you subtract. So when you subtract this, the sum of these figures on the debit side from the sum of these figures on the credit side, you are going to get the balance carried down from the debit side, which in this case is 3,210. And after being carried down from the debit side, you are brought down on the credit side. Okay, so that is the purchases ledger control account, or accounts payable control account if you prefer. Let's take a look at the debtors control account. Alrighty, so we're seeing information regarding account receivable. So let's start. Opening balances, 9360 on the debit, 470 on the credit side. So let's populate that here. So on the debit side, 9360, credit side 470. So remember, your sales ledger control account, or your accounts receivable control account, or your debtors control account summarizes the entire sales ledger, which means the accounts of all of your debtors. So therefore, since debtors is an asset, this is the summary account of a group of assets, which itself therefore is an asset or represents an asset. So debits to increase, credits to decrease. So assets usually have debit balances. So why do we have a credit balance? So much like we might overpay a creditor, and that's why we had a debit balance in the accounts payable control account, our debtors might overpay us, so we might end up owing them a refund for a miscalculation or whatever it was. So anytime we owe them money, that's a liability, and a liability has a credit balance. So that's why you're going to see a credit balance here, right? So it's not that we're going to take the entire debtors account and put it in the purchases ledger because we owe them a little bit of money. That's not how it works, all right? Okay, let's start populating with the rest of the information. So sales for the month of April. Again, they did say at the start of the question that all sales and purchases are made on credit. So credit sales will go on the debit side. Why? Because when you make credit sales to your customers, they end up owing you money, or in most cases, more money, which means your asset of debtors is increasing. And to record an increase in an asset, you have to debit the asset account. Next, we have sales returns. So if sales increases the amount of money our debtors owe us, sales returns does the opposite. Why? Because when debtors send back goods, they return goods to us, they no longer have to pay for them. Hence, they are reducing the amount they owe us, which is a decrease in our asset. So to record a decrease in an asset, you have to credit the asset account. Next, I'm seeing receipts from customers. So receipts from customers, that means money received from our customers, our credit customers. In other words, they are paying off what they owe us. And when they pay off what they owe us less, which means the asset of debtors is going down. And to record a decrease in an asset, you have to credit the asset account. Next, we have discounts allowed. So much like when discount received represented, where our creditors, decrease the amount we have to pay them in order to encourage us to pay faster, thereby decreasing the liability. Discounts allowed is where we decrease the amount of money our debtors owe us by reducing the debt. Hence, we decrease our asset, and reductions or decreases in assets are recorded via credits in the asset account. All right, let's see what else we have here. We have a few things. So we have bad debts. Now, bad debts, that's when a customer goes bankrupt or whatever, refuses to pay us, and therefore we can no longer expect to receive any money from that person, which means we have to write off the bad debt, which means that's going to decrease the amount of money that we are owed in total. Therefore, the asset is going to go down, which requires, as we said before, a credit to the asset account. Next, we have customer's check returned, $970. So when the customer paid us, that went on the debit side to show the decrease in the asset. If something was wrong with the check, like it wasn't signed, it was the wrong date, the words and figures didn't match, or there was some other problem, and the bank sent back the check, it means we didn't actually get the money. So it means that the amount of money that that debtor owes us didn't go down. So in the books, we have it recorded as going down, but it didn't actually go down. So what we need to do is we need to undo the receipt. So that means we're going to have to counterbalance this credit entry. And how do you counterbalance a credit entry? You go on the opposite side, which is the debit side, and put the return check right there. So you're going to see a debit here saying $970, customer's check returned. We also have the closing balance item of $550 on the credit side. So that's the closing credit balance. But don't forget, just like in the creditors control account, we also have to deal with the set off. So the $375 is going to be used to set off the amount here, and that's going to go on the credit side because, again, set off is a cancellation or reduction of common debt. So it cancels or reduces a liability, and it also cancels or reduces an asset. In the case of a liability, we debited the liability account, and in the case of the asset, we are crediting the asset account to show the reduction. Now, we also have the closing credit balance, which means we have to find the closing debit balance. So the closing credit balance will, of course, be brought down on the credit side, as you can see here, $550. But of course, prior to being brought down on the credit side, you have to be carried down from the debit side. So you're seeing that $550 here. Right, so again, to find the closing debit balance, which will be brought down here, and prior to being brought down on the debit side, you have to be carried down from the credit side. You're going to add up everything here, and you're going to get a total. Thereafter, what are you going to do? You're going to add up everything here and subtract it from, everything here, including 375, and subtract it from 98,770. And that's going to give us the balance carried down, which is 24,965. So now when we add up everything in the column, including the balance, we are going to get the same total. And of course, don't forget to bring your balance down on the debit side. Okay guys, so there you have it. That was the solution for question 2 from the May 2014 POA Paper 2. If you have any questions, please feel free to leave them in the comment section below. If you want to check out any more videos, I'm going to put some cards up here. Don't forget to subscribe and be sure to check out my website for some free POA handouts that you might find useful. Anyhow guys, as per usual, thank you again for watching. Take care of yourselves and I'll see you next time. Bye.